Hey everyone, welcome in to another daily editorial here on the KE Report. Chatting with Dana Lyons, we're going to be discussing the overall health, potentially still bullish health of the U.S. equity markets, and then tying in the dollar and yields to opportunities in other stock markets abroad. Dana is a fund manager and editor of the Lyons Share Pro website. I'll post a link to that website in the show notes. Dana, just to follow up on our last call from 2 weeks ago, look, you pointed out that your Q4 outlook for markets was still fairly strong. Your models were showing you that there's still a lot of opportunities out there, and sentiment, while it was getting a little bit extreme on the bullish side, there still could be room to run. We still have these markets running. The S&P is over 5,800. It's closing in on 5,900. Equal weight S&P also moving. Look, across the board, there's a lot going higher. What's catching your eyes? Any new sectors that are breaking out, or at least your models are showing you there's still upside here?
Yeah, sure. Thanks, Corey. Good questions. I think broadly speaking, the key word being broadly, we do have the large caps having a nice day today, and they've bounced back, except for the NASDAQ. They bounced back into new high ground. But what's really got our attention and has had our attention, even during the third quarter when we saw, the tech-led correction, our models never did turn negative, and what has kept them up have been the broad indicators, the internals, the breadth of the market, which have remained pretty firm. And as you mentioned, the broad averages, some of the new broader averages just of late that have now started to break out after, hanging in for a while, consolidating, now seeing some breakouts in some of those broader averages like the equal weight S&P, like you mentioned, and just in the last few days, some of the mid cap averages breaking out to all-time highs. So the broader stock market, which feeds a lot of the components of our models, has hung in there, is still in good shape, and I think it's set up for further run over the next, this quarter, certainly over the next intermediate term, which we call anywhere from 2 to 6 months. So I think it's still on firm ground over that time period, as long as that broad market hangs in there. I think there are some short-term red flags that have us keeping a little bit of powder dry, though.
Well, Dana, just on the bullish side, just seeing that the equal weighted S&P is broken out to new highs, the mid caps have broken out to new highs. You were noting off mic that you're still watching the pure value indices to see if they'll break out, because it would even show even wider participation. Maybe just break down what you're looking at there and why all these signals, are bullish for the intermediate term.
Sure. So, like we've discussed in the past, our models are heavily influenced by breadth indicators, internal indicators, what the broad market is doing, because studies have shown about 70 to 80% of the direction of a stock is due to the direction of the overall market. So we want to be aligned with whatever the overall market is doing. And the more broad indicators, the more broad indices that are doing well, that are moving higher, the stronger the market is. And we did see just this week, like I mentioned, the mid cap average breaking out to new highs after consolidating basically the whole year. So that's a positive, as well as the equal weight, some of the equal weight averages. Also, like you mentioned, some of the pure value indices, which strip out all of the growth aspects. We've tracked them for many years, and especially the small cap pure value index really is a good barometer of risk on versus risk off. So when that's moving to new highs, it's a legit risk on type of environment. And that's getting close to breaking out after consolidating for the better part of a couple of years. The mid cap pure value has been, like I said, consolidating since the beginning of the year. That just broke out to new highs over the last few days. So you're seeing just a bevy of broad-based indicators, of broad-based evidence of still a firm market. Even if we do see some short-term hiccups here, it's the type of market that can take those hiccups in stride and eventually turn higher and have another more durable rally over the next several months.
So, Daniel, look, it's paid off for investors to be long markets and long a whole lot of different sectors. But with all these different sectors hitting all time highs, consolidating near all time highs, when does this all start becoming late cycle behavior and the market needing a natural longer term pullback rather than just these couple week dips that seem to be bought so quickly?
Well, I think you've seen kind of a rotational pauses or corrections on certainly technology you saw take it on the chin post July. You've seen some of those defensive sectors that have really come on over the last quarter, healthcare and utilities, consumer staples, REITs. They really hadn't done that much for a while, so they had plenty of fuel stored up for a more durable run. So you're seeing kind of a rotation of relative strength where one sector or one area of the market will kind of take a pause where another segment market kind of carries the load. And as long as they continue to see higher highs, higher lows, that's a healthy market because you have a broad array of potential relative strength names. And plus, you don't have just a limited select number of names that you have to chase higher. You get the pullbacks in some names that are well positioned, like some of the defensive names over the last week or so. You could have added to into a pullback, even as some of the other names like the financials, industrials, materials continue to move to new highs. So you're getting buying opportunities in some segments of the market, even as others continue to hit new highs. So that's the kind of market that we like best, one where, okay, we do want to concentrate in relative strength, but there are a wide range of potential relative strength names that you can kind of stagger your entry points and exit points in.
Well, Dana, let's shift over to the currency side of things and take a look at the US dollar. It's been a little stronger than many people were expected. Some are looking at longer term charts and saying it's still in a downturn, but other people are getting more bullish again and thinking it may break out. How are you looking at the greenback?
Yeah, so for us, looking at the dollar, it's still, I would say the benefit of doubt is still to the downside. We got to bounce off of the low end of the range we've been in for maybe the last couple of years. Still have, a significant amount of resistance on the chart to get through. So our thought is it's still the benefit of doubt is still to the downside. We're still seeing lower highs. So we would be apt to be selling or shorting the dollar into this rally. And conversely, if this is a counter trend bounce and the dollar does start heading down again, that would certainly aid and not just the anti-dollar assets, some of the commodities, the metals, but also some of the international markets, some of the internet US-based, especially international indices or ETFs, I should say, that have done well this year, have pulled back given the bounce in the dollar, and with a continued move lower in the dollar should benefit from that and continue their bullish trend.
Do we potentially get a breakdown in the dollar then? Because the dollar market has been kind of boring. It's about a year and a half now that it's traded in a range from pretty much 100 to 106 on the dollar index, but most of that time, again, just kind of trending around this 102, 103, 104 area.
Yeah, it's basically gone nowhere for, almost 2 years. But if you scroll back to 2022, obviously you had that peak. So we are hitting lower highs and now basically horizontal lows. So from a pure charting standpoint, you might be looking at some sort of a descending triangle, which typically resolves to the downside. So it might take a lot to get through those lows that we've seen over the last couple of years. But again, you're seeing the lower highs, you're seeing lows down in the same vicinity. So if that trend continues, eventually you run out of space on the downside and you do break those lows and move on to lower lows. So it wouldn't surprise me to see that, just the way that the chart's based right now. And also looking at some of those international equity ETFs, especially the hedged currency ETFs like Hedged Japan, Hedged Europe, which after leading for the better part of the last few years, they are starting to break down or significantly lag, which would lend another piece of evidence towards continued dollar decline and strength in some of those foreign currencies.
Well, Dana, let's dig into that topic a little bit further. So for people listening in, there's the regular international ETFs, and then there's some that are hedged against the currency differential. What clues lead you to believe that there could be more downside in the dollar based on those international hedged ETFs, and maybe just kind of unpack the dynamics behind it?
Yeah, sure. So you have a handful of currency hedged ETFs. For example, DXJ is a Japanese equity ETF, but it hedges away the yen. And the HEDJ is similar, a European hedged ETF that invests in European equities, but it hedges away the euro effect. So when the euro is strong or the yen is strong, it kind of negates that advantage, actually works against the advantage of hedging. So most of the international equity-based ETFs here in the US are based in US dollar. So naturally, when the dollar is strong, starts to eat away at some of the returns in the equities. Whereas when the dollar is weak, it exacerbates the strength in those international markets. So just looking purely at the charts of DXJ and HEDJ, you can see after leading for most of the year or better part of maybe 2 years almost, you can see those hedged international ETFs, DXJ, HEDJ, are really lagging now significantly low. Their recent highs well below those highs that we saw in the summer, which suggests, further strength in those foreign currencies, further weakness in the dollar. So if I'm looking to buy some international equity ETFs nearby, I'd certainly look at those unhedged ETFs, which would benefit further from further dollar weakness.
Dana, is this a trend that you're seeing in these markets then? This catch up trade, as much as the Magnificent Seven carried markets and international markets lagged behind some of those tech plays, we're seeing pretty much all these lagging sectors in their own time play catch up to all time highs?
Yeah, well, I think it points to a couple things. One, just the overall strength of the broad market. The more sectors, the more market segments we're seeing do well. The stronger the broad market is, the more better the foundation is in the broad market. And secondly, when it's just a simple matter of supply and demand and psychology. When certain segments of the market get a little bit too popular, you run out of, the next buyer. There's no one left to buy, so there's nowhere to go but down. Right now, we saw that in tech and the semiconductor space in July led that correction down. That's a good example of that. But we found other sectors, other market segments that have held up well to kind of rotate that money into. So that's a healthy situation. You don't want to be the last buyer, and you don't want to stick around too long once that tide does turn.
Are there any sectors you're just flat out avoiding, or that you see a lot of relative weakness in that you're even shorting?
We're putting selective, just maybe short-term hedges on different sectors, different market segments right now when we see opportunity, just because we think the next month might be a little bit dicey. We did put on a little short in the small cap, the Russell 2000 earlier today, as it tests the former highs from the former rally highs, but we expect that to just be a trade. Some of the general tech and semiconductor-led names that peaked in July, still well below those highs, so we would certainly avoid those. At the same time, there are some technology names that actually look good to us. A software ETF, IGV, a cybersecurity ETF, CIBR, that have really been forming kind of a cup and handle type pattern over the last 2 years, and just over the last week or two have broken out. So any sort of a pullback in those tech names towards that breakout level, we'd be buying more aggressively. But I guess the areas that led that correction in the third quarter, we'd stay away from some of the general tech and semiconductors, and also Japan for now, while it consolidates that big run that it had.
All right, Dana. Always interesting to hear what you are trading, the opportunities that you're seeing out there. Sounds like still these markets, a lot of opportunities. I keep on waiting to hear that your models are turning negative or simply just getting far too overheated, We are not there yet. So, hey, I guess continue to ride this wave higher in a range of sectors that a number of them continue to just move to all-time highs after consolidating for a period of time. Always interesting, Dana. Again, Dana Lyons, fund manager and editor of the Lyons Share Pro website. Click that link in the show notes to visit that website. Dana, we'll chat with you in another couple weeks. Have a great rest of your week.
Sounds great. Thanks a lot, guys.